Welcome back to the Wall Street Podcast. Today, we're initiating a deep dive into a pretty crucial report from UBS AG's London branch. It's titled Copper, U.S. Copper. Tariffs on, Tariffs off. It just came out, finalized July 31st, 2025.
That's right.
And it really scrutinizes this recent shift in U.S. copper tariff policy.
Huh.
We're looking at the market impact, pricing, inventory dynamics, the whole picture.
Exactly. And the core policy shift is quite significant. The U.S. has, well, exempted imports of copper cathode, anodes, and mats.
So the raw forms, basically.
Right, the unrefined stuff. Exempted from that proposed 50% Section 232 tariff, the national security one.
Okay.
And that exemption kicked in August 1st. But importantly, tariffs will still apply to the copper semis.
Like pipes and wires.
Pipes, wires, things like that, yes.
And this reversal, it caused quite a stir in the market immediately, didn't it?
Oh, absolutely. A sharp reaction. The Comex price for copper plummeted.
How much are we talking?
Over 20%, which brought spot premiums down close to zero almost overnight.
Wow. So UBS's view then, they put out this report.
Well, UBS still holds a structurally constructive long-term view on copper. The fundamentals are there.
But near term?
Near term, they're cautious. And the reason is this policy change is basically unwinding what everyone called the U.S. copper tariff trade.
Right, that trade that really warped the physical market in the first half of 2025.
Exactly. It caused significant distortion. It's interesting because, the U.S. accounts for less than 10% of global refined copper demand.
Which seems relatively small on a global scale.
It is. Yet, just the threat of that tariff created this huge premium on Comex versus the LME in London.
And that premium just sucked metal into the U.S.?
Precisely. It attracted massive inflows. Year to date, U.S. refined copper imports were up, get this, 130% compared to 2024.
130%? That's staggering.
It is, and it led to this estimated excess inventory build. We're talking maybe 500 to 700 kilotons sitting in the U.S. by the end of July.
Which represents what percentage of their annual use?
About 30 to 40% of annual U.S. refined copper demand. Just sitting there.
So the consequence now is lower imports for a while.
Materially lower U.S. imports are expected for, say, the next 6 to 12 months. This excess has to be absorbed.
Re-exported, maybe? Dumped somewhere else?
That's a possibility, too. Re-export or even dumping of that metal. The market has to clear it somehow.
Okay, let's pivot to the equities. Module 1 here. What does this mean directly for the copper miners, the producers?
Yeah, good question. Freeport-McMoRan, FCX, they were seen as the biggest beneficiary of those high Comex premiums before the reversal.
So they face the biggest downside now.
That's what the UBS sensitivity analysis suggests. Roughly a 10% potential downside to reported EBITDA. Maybe 15-20% to attributable EBITDA.
And free cash flow.
If these premiums stay near zero, you could see maybe a 200 basis point impact, over 2% hit to free cash flow.
And the market reacted quickly to that.
It did. FCX traded down about 9.5% right after the announcement. Others like Rio Tinto, Southern Copper, they also face negative impacts, but probably to a lesser degree than Freeport.
Okay. Moving to Module 2. This whole situation with the tariff threat causing hidden inventory builds, it makes you wonder, beyond copper, how useful are these visible exchange inventories, like LME stocks, for understanding supply and demand in other base metals?
That's a critical point. Exchange inventories, frankly, don't tell the whole story. There can be significant unreported off-exchange inventories that really distort the physical market reality.
You have examples?
Sure. Take aluminium. Over 90% of the LME stocks are apparently held in just 2 Asian warehouses, and it's mostly Russian origin metal.
Which raises questions about its availability or use as a real industrial indicator, right?
Exactly. Its utility as a gauge of immediate industrial health is questionable. Or look at zinc. There was a huge delivery into Asian warehouses late in 2023. It just highlighted, again, that substantial inventories exist completely outside what's reported on the exchanges. You have to dig deeper.
So, final module then, Module 3. We have this immediate downside risk for copper prices because of this inventory unwinding, this market distortion clearing out.
Correct.
How should investors square that with the generally positive long-term outlook for copper that we keep hearing about?
It's about distinguishing the signal from the noise, really, the current near-term volatility. That's largely the unwinding of this specific tariff-induced distortion. It's a market correcting itself.
Okay.
But the underlying structural demand drivers for copper, electrification, EVs, renewables, AI data centers, grid buildouts, those fundamental factors underpinning the positive long-term view, they remain intact.
So this current softness is likely.
Temporary.
Likely a transient phase, yes.
Yeah.
It's related to inventory absorption. It's not necessarily a signal that long-term demand is collapsing. It's more about the market rebalancing after that policy shock.
Right. So a near-term headwind, but the long-term story hasn't fundamentally changed.
That's the way UBS seems to frame it, and it makes sense given the circumstances.
Yeah.
Okay. As we wrap up this deep dive, then, something to think about. What broader lessons can we maybe draw from this rapid unwind of the U.S. copper tariff trade, specifically about how policy, market psychology, and, well, fundamental supply-demand balances interact, sometimes quite dramatically, in these global commodity markets?